Before stock markets react, before GDP numbers are released, and long before inflation shows up in the official data, the global economy sends out signals. Some of the earliest signals come from a place most people completely ignore. The shipping industry. Why? Because shipping companies don't deal in opinions or theories. They deal in real cargo, real demand, and real orders. Every container moved, every bulk shipment booked, every new route opened is hard evidence that businesses are buying, producing, and selling more. And when shipping slows down, it's often the very first sign that global demand is starting to weaken. So in today's video, we're going to uncover a hidden truth. Shipping companies quietly predict global demand, and they often do it before anyone else. We'll break down why shipping is a real economy indicator, what signals you need to watch, and how you can use this data to understand where the global economy is heading next. Let's get started. To understand why shipping is such a powerful predictor, we need to grasp one key idea. The modern economy is global. Most products we use don't come from just one country. They come from complex global supply chains. A smartphone, for example, might be designed in California, built in China, using chips from Taiwan, rare metals from Africa, and machinery from Europe. This means global demand isn't just about what's happening in your local area. It's international. And the only way international demand becomes real is when goods physically move from one place to another. That's why shipping is so critical. It's the system that transforms economic demand into physical trade. It's the bloodstream of the world economy. So, when shipping volumes rise, it means businesses are ordering more goods. Factories are busy and consumers are buying. When shipping volumes fall, it means businesses are pulling back. That's global demand in motion, right before your eyes. Most of us learn about the economy through news headlines. But here's the problem. By the time the headlines mention an economic slowdown, it's already late. The damage has been done. Shipping companies see the changes much earlier because they sit right at the beginning of the supply chain. Think about it. When the global economy is expanding, what happens first? Factories book more containers to ship their products. Orders for raw materials like iron ore and coal increase. Ports become crowded with activity, and as a result, shipping rates go up. Shipping companies see these trends long before they show up in official reports like GDP, inflation numbers, or company earnings. Why? Because the shipments happen first. The data comes later. So, if you want to get the early signals, you don't watch the end of the economic story, you watch the beginning. And shipping sits right at that beginning. To really understand these signals, you need to know that there are two major worlds within the shipping industry: dry bulk shipping and container shipping. They tell different stories. First, there's dry bulk shipping. This involves moving raw materials like iron ore for steel production, coal for energy, grain for food, and fertilizers for agriculture. When demand for bulk shipping rises, it's a powerful signal of industrial growth. It means countries are building more infrastructure, factories are ramping up production, and construction is booming. This is closely tied to industrial expansion, especially in developing economies. Then you have container shipping. This is what most of us picture when we think of shipping. Those massive ships stacked high with containers. These containers carry finished goods like electronics, clothing, furniture, and appliances basically. Everything you'd find in a store. When container demand rises, it's a direct signal of strong retail demand and healthy consumer spending. So, bulk shipping often gives you the earliest warnings about a potential recession because it reflects industrial demand. Container shipping, on the other hand, is a great predictor of future consumer inflation and retail sales. Both are incredibly powerful, but they measure different parts of the economy. So, what exactly should you be watching? Here are the key signals that shipping companies monitor and react to in real time. First, and most importantly, are freight rates. This is the price to ship goods. When demand for shipping is high, but there aren't enough ships, rates go up. When demand collapses and there are too many ships available, rates fall. Freight rates are like the price in any marketplace. They are real-time signals of supply and demand. Second is capacity and vessel deployment. When shipping companies see strong, sustained demand, they do things like add more ships to their fleet, increase the speed of their vessels, or open new shipping routes. On the flip side, when they start canceling routes or reducing the number of sailings, which they call blank sailings, that's a clear signal that they expect demand to weaken. Third is port congestion. If ports are getting crowded and ships are waiting in line to unload, it usually means trade is booming. But you have to be careful with this one. Congestion can also happen because of disruptions, like a labor strike or a blockage in a key waterway. So it has to be interpreted with context. And finally, booking volumes. Large companies like retailers and manufacturers book their container space weeks or even months in advance. So, if these forward bookings start to fall sharply, it's a powerful sign that businesses are expecting lower demand in the near future. These indicators often move long before many traditional financial indicators. Another reason why shipping is such a reliable signal is that it's very difficult to fake. Stock markets can soar based on emotion and speculation. GDP projections can sometimes be influenced by politics, and economists' forecasts can be biased. But ships don't move because of opinions. Ships move because a business paid real money to transport real goods. Shipping data reflects actual economic decisions made with real capital. That's why these indicators are often called real economy indicators. They show what businesses are actually doing, not just what they're saying. Now let's talk about downturns. When a recession is on the horizon, demand doesn't just fall off a cliff, it weakens quietly at first. Companies don't immediately issue a press release saying, "We expect a recession." Instead, they do something much more subtle. They reduce their orders for new products. They try to sell off their existing inventory. They delay shipments and, in some cases, cancel bookings altogether. All of this reduces the demand for shipping. And when shipping demand falls, the shipping companies notice it immediately. This is why shipping data often weakens long before official recession declarations are made, before unemployment starts to rise, and before corporate earnings reports show a collapse. Shipping is the canary in the coal mine. It doesn't predict recessions with perfect accuracy, but it often signals those critical turning points in demand very early on. But shipping doesn't just predict recessions, it can also help predict inflation. Think about it. The cost of shipping is a component in the final price of almost every product you buy. If container rates suddenly surge, as they did in 2021, retailers have to pay more to get their products. Manufacturers have to pay more for parts, and the entire supply chain comes under pressure. Those higher costs eventually get passed on to us, the consumers, in the form of higher prices. This creates a lag effect. Shipping costs rise today, but consumer prices might not rise for another few months. So by watching freight rates, you can often predict where inflation is headed. This is exactly why freight rates were one of the most important indicators during the 2020 to 2022 period. The surge in shipping costs came first, and the spike in inflation followed. This brings me to an interesting point. Some of the best economic insights come from the most unexpected places. Shipping CEOs, in their quarterly calls and interviews, often talk about things like booking weakness, demand on certain trade routes, inventory cycles, and changing customer behavior. They don't use fancy macroeconomic language. They're just talking about their business. But their business is literally a reflection of global demand. If demand is strong, they add capacity. If demand is weak, they cut routes. So when a shipping company starts saying, "We're seeing weaker bookings for the next quarter," or "We're reducing sailings on the Asia-Europe route," that's not just a business update. That's a real-time demand forecast. And if they say, "We're seeing strong volume growth," or "We're expanding our fleet," that's a forecast for growth. Shipping companies may not be economists, but they act like real-time sensors for the global economy. So how can you, as a viewer, use this information? Here's a simple strategy. If you see freight rates rising sharply and shipping volumes are also rising, it's a strong sign that global demand is strengthening. If you see freight rates collapsing and shipping companies are announcing that they're reducing capacity, it means demand is weakening and the risk of a recession is rising. And here's a crucial third point. If you see freight rates rising but it's due to a disruption like a port closure or a blocked canal, the risk of inflation is rising, but it doesn't necessarily mean that demand is strong. Context always matters. But even with that nuance, shipping signals remain one of the best early warning systems for major economic trends. So, the next time you hear an economist predict where the economy is going, ask yourself, what do the ships say? Because the global economy moves through trade, and trade moves through shipping. Shipping companies see what's happening to demand first before the inflation reports, before the GDP numbers, and often before the markets react. They don't predict with theories, they predict with cargo. And if you learn how to read their signals, you can understand global demand far earlier than most people. If you enjoyed this video, hit that like button, subscribe, and comment demand below if you want more episodes about hidden global economic indicators. In our next video, we'll explore how shipping disruptions can create sudden inflation spikes, even when demand isn't particularly strong.